Okay, welcome to the Business Briefcase podcast, brought to you by Loandesk.com.au. I'm Lee, and I'm here with Simon.
Morning.
Today we wanted to kick off the first podcast we'll be doing in the Business Briefcase series. We wanted to talk about probably one of the most popular business loan categories that we've had since we started or kicked off the Loandesk journey, and that's called Unsecured Business Loans.
Yeah, I think that's a good point. We should probably stress that if you were to look at the volume or at least the interest which has come through Loandesk in terms of loan types, this loan type far outpaces the rest. Basically, you could see it's probably a fivefold in terms of volume of A, the interest, and B, the actual settlements as well, which is, I guess, the business owners putting their cash where the mouth is as well.
Yeah, I mean, I've been very surprised. I mean, when we first put together the 21 loan categories, which we've been working on over, I guess, a year now, we didn't really expect that unsecured lending space to be as popular as we thought it would be. And, you know, the settlements just keep on coming, and where, you know, matching those lenders directly has been, you know, it's been, I guess, one of our proudest achievements to date. We've helped so many business owners so far. I mean, Simon, you'd know firsthand because you deal with the lenders directly.
Yeah, that's right. And it's kind of cool because if you think about this loan type, it is still relatively new now. I think it started in the US probably close to 15 years ago, so it's not so new in that terms. But from what I can tell, 2008 was about the time when the first of these types of lenders became, or I guess they started to service the Australian market. So, 6 years? But we should probably clarify exactly what we mean by the unsecured loan type, and I guess we should probably start with what the name means. So, what's your thoughts on what the term unsecured means?
Yeah, I mean, I've been in the game for quite a long time now, and unsecured can mean quite a different number of things. Some lenders will say unsecured, and that could mean, well, we're not taking property security, or there's no other assets, essentially. So an unsecured business loan essentially, technically, really is supposed to be a blanket security over a business and not over any specific type of piece of asset, like a piece of equipment or a property or whatnot. Then you move to another realm as well. They don't take any security directly over your business, but they might take a personal loan, personal guarantee, from the director. So it depends on which way you interpret it, and it's very important to, I guess, when you're making these inquiries with lenders, to be very specific or ask them that specific question: what are you taking security over? Yeah,
and that's how I see it. So yes, there's no physical security. So if you don't make good on your debt, they won't come and take something off you, but something bad still will happen. Basically, it's essentially secured against your personal credit file, and if you don't make good on those payments, then there's going to be, I guess, some consequences of that. So it's not, I guess, a free loan. You certainly still need to treat it as such. But what about, so we say unsecured loan, but what we're really talking about is, I guess, a category which is two specific loan types, right? So we've got the merchant cash advance, which is the one that came first, right? And we also have one that's relatively new. It sort of came slightly later, and that's the fixed term loan. So should we? Yeah. So going back just quickly for those that probably haven't heard of what a merchant cash advance is, that's in short called an MCA, which was the popular type, which, you know, the lenders in Australia, the alternative lending space, they brought to Australia here first because that's how it was set up in the US, and now it's evolved more. We see that it's evolved more into an unsecured business fixed term loan, which is the way that the online lenders in the US, like ondeck, Kabbage, and Lending Club, are doing it, but an automated lending online platform. Whereas in Australia, we're a little bit behind. We haven't got lenders where we've got, you know, automated online lending, but they're doing the exact same style. So the MCA difference, or merchant cash advance, was purely based on funding for retailers, essentially, that accept credit cards. Or you know, direct debit, what do you call them, Visa debit cards. And what they would do is effectively redirect those payments into the lender's account and lend you a portion of that turnover. So
they would look at your past history of what you turned over, then predict what you're going to turn over in the next 12 months or 6 months, and lend you a certain percentage of that turnover. And then as your payments come back in and you're transacting, they clip a little bit of that every time it comes through to repay the loan.
That's right. So the main difference between, I guess, the MCA and the fixed term loan is the method of payback. So with the MCA, as you said, normally what happens is the funds are redirected from your existing point of sale processor, basically. So the funds are put into an account controlled by the lender.
Yep.
They then clip a small amount, say 5% of all future sales until that loan is paid back, basically. That's right. There is another way which is popular in the States. It's not technically that possible here. It depends on your payment processor, but some will let you actually set up a split configuration. So instead of actually going into an account which is controlled by your lender, what will happen from your payment processor is they'll send, say, 95% of all sales to you and 5% to the lender. Now that is better because if you think about the former case where the funds are transferred first to a lender's account, basically that's an extra day that you wait for your money. So it's not that cool, basically, right?
That's right.
So if you can do the split processing, do it. But it's unlikely you have a processor in this part of the world that can do that.
Yeah. So that's right. So the MCA, then moving on in Australia especially, because the banking rules are different and the banks tend to be able to control the merchant accounts, so they sort of prevent that split payment stuff. So the guys that we're doing in Australia, the lenders that Loandesk has on board in the network, they evolved and moved into a more fixed-term lending product, which is now evolved into not just retailers, but effectively every type of business that accepts payments in, which That's of course we all do. But so what they do now is they'll come in, they will look at your turnover, your previous and your future payments, and effectively they put in a direct debit, don't they? They put in a direct debit that does automated
I think the main thing basically is that they want to see, yes, they would probably like to see some forecasted revenue figures, but the main thing and what they're really after is they want to see essentially just the last 3 months worth of transactions going through your bank account, right? And they'll take the average of that, so they get a relatively good idea as to what your cash flow is, and then they'll give you around about 1 month's worth of turnover, basically, right? So that doesn't mean that if you have 2 slow months and then 1 ripper month, right? So you do 50k for the first 2 months, and then on that third month you do 150. You don't get your 150, you get your 30% of 200, right? So you'll get your 65 or so, basically, right? And the difference being with the MCA is that instead of the money being redirected into an account first, which is controlled by the lender, there's a debit which is set up, and first the funds come to you just as per normal trading, but then there's a pool done essentially, and the money comes out from your account back to the lender. Now obviously it's slightly more risky for the lender if you think about it, because they lose control of the funds from the front end, but it seems to be the way that most of these types of loans are going. And if you think about it, because with the first type, it's not really that great as I guess with the MCA, because you've got to change your payment processor, you possibly have an extra day that you're actually waiting for funds. Not great when you actually need the cash flow, right? That's why you're sort of in the game in the first place. So a lot of the loans are going down this second path where you receive the funds first, but then you pay back a set amount each day normally to the lender until that loan is paid out.
So just what you said before, they look at previous 3 months bank statements. I mean, the qualification for these types of loans, I mean, you know, they're not a startup loan, are they? They're not. I mean, we've noticed that you can't really qualify if you're a startup.
You've got to have some turnover, right? So, but you've only got to have some. You know what I mean? So, whereas bank funding, you essentially have to be trading for 2 years most of the time, right? With these guys, we know we have lenders who will look at deals where you've only have 3 months worth of trading history. Now that's pretty unheard of, or certainly was a few years ago. But I'd say generally you would need to have 6 months worth of trading history, and what you can expect basically is that you'll get 1 month's worth of revenue. So there's a chunk of cash, and you're expected to pay that back over a period which you can possibly choose, but normally it's around the 9 months, isn't it? Right?
Yeah, 6 to 9 months. Yeah, I think maybe the shortest is 3 months, but I mean, you don't even want to be taking a very small amount. I mean, it's hardly worth it. So yeah, just I guess on qualification, you've got to have regular repayments coming in, and the lenders are looking for your cash coming in and your cash going out, and each month or week, what's left over in order to repay that loan. If you've got more cash going out than coming in every week or every month, they're not going to be able to lend you too much money, because they want to make sure that you've got enough cash left over essentially to make that regular repayment and make it on time. So yeah, that's...
Yeah. And they will actually take that into, I guess, consideration as well. So if they can see that, hey, you don't have a lot of free cash flow, then they aren't going to say, hey, here's 1 month's worth of revenue, you must pay that back in 3 months, because that's not going to work for anyone, right?
No.
They'll actually split that out and say, this is a 12-month loan or this is a 9-month loan effectively.
Yeah.
Yeah,
because we've got one of the lenders we deal with quite regularly. Depending on the business owner situation, they will sometimes give you a month reprieve, or I guess a honeymoon period, where you don't have to make those regular repayments, because I mean that's probably the main reason why you came to them, just to get that cash, pay for some stock or run a campaign or whatever, and get that cash flow going to be able to make those repayments. So they give you that. So that's one of the lenders. They don't all do it. We've got a number of lenders on board, and which isn't great for borrowers, but it makes it easier for us, because we can load up their different criteria. But each lender has a different set of criteria. They all do that unsecured business loan fixed term product, but specifically each lender has a different credit criteria. So one might have a high credit where you've got to have perfect credit. The other might take a bit more of a risk. The other lender might take into other assets into consideration and make an assumption that you're a good credit risk based on the other assets. Yeah,
I think it's worthwhile that we just go over very quickly what the qualification criteria is for these loans. So essentially, as we've spoken about, you've got to have some revenue, basically, right? So you've got to be trading for a period of time, probably 6 months, maybe 3 if you've got some strong turnover in 3 months, but let's just say 6 months minimum. You need, in terms of personal credit, most of the lenders, they say that if you have a bad personal credit file, it's not going to hamper your chances too much. I guess that would depend on the actual lender, wouldn't it? So we've seen some business owners not get the loan because of that reason, and others it doesn't seem to affect. But certainly, if you have a poor personal credit file, it's going to probably take an impact, and that's really because for this type of loan, that's the only security per se that these lenders have, right? So it is essentially a personal guarantee which they're taking for this business loan.
Yeah. So when you say the credit file, credit quality, we're not talking about telco defaults. You might have defaulted on a I don't know, telephone bill.
Yep.
But if you've got a credit default on a credit card, which is essentially a loan, a personal loan.
That's right.
Essentially, if you haven't been able to make those repayments, then the lender's going to see that on your file and say, "Well,
and that's a massive red flag." Yeah. So if that is there, and if someone does have that sort of situation, then really they must get that paid, basically, because the moment that you have a credit ding marked as paid, then your options really start to open up.
That's right. Yeah. So we just wanted to, before we wrap up in the next couple of minutes, we're just going to go over one thing which came up, because we were able to match a borrower that came through Loandesk just recently, actually, which we were quite surprised with, and we weren't actually sure whether or not the lenders would do this, but I guess the main thing to talk about is how does the unsecured business loan or lender affect your other credit lines? So if you've got other banking loans in there, what are they? And Simon firsthand experienced this. We had a borrower come through Loandesk. They filled out their profile. They were matched. They had business loan already in place from a bank. They had a receivables facility from an invoice factoring company, but they were still able to qualify for, I think, what was it, 70, 75.
It was a large loan, and let's just think about that, right? So we've got a business owner who has managed to get some funding from his bank, essentially, right?
Yeah.
And he's probably outgrown that, essentially, and he's gone to his bank manager and said, please, can I have some more money? And they said no, right?
Yep,
he's then probably gone off and done some research, and he's found a factor who might suit him. He's then gone back to his bank manager and said, hey, can I please have a release over my receivable so I can get this additional funding with this third-party financier? And then they've said yes, which they sometimes do, but it's quite hard.
Yeah.
He's then outgrown that probably, and he's managed to get a loan from a third financier, essentially secured against the same cash flow, right? Which is his business cash flow. Sorry, not secured, but it's based off the same cash flow, his business, right? So it's pretty incredible that
pretty cool.
He can get down the path of 3 different lenders and continue to grow his business that way.
It's pretty cool that we're able to, I guess, match him.
I was impressed.
Yeah, I was impressed as well. But it's great. So that's a good case study. We're going to wrap that up there. So thanks for listening. That was the Unsecured Business Loan. Our first podcast coming up. Next podcast coming up is the debtor finance or invoice factoring one we're going to talk about. We've got quite a bit of experience in this topic, so we're going to break down the industry, go through all the types, the facilities, how lenders think, and how the market's changing with some new never be foreseen or heard of online lenders coming into this space. Thanks for listening again. I'm Lee. And
I'm Simon.
Thanks for listening.